From the morning reading. Over the past 3 months, U.S. companies have issued $57 billion in bonds, at least partially used to pay for dividends and share buybacks. That's the largest amount in history, surpassing previous peaks in 2013 and 2007. Clearly, part of the implications of cheap money, and obviously these companies are taking this opportunity to borrow at very, very low rates and then to use it for current needs, including to pay dividends. And we have the famous example with Apple, where it's cheaper for them to borrow money to pay those dividends than it is for them to repatriate the money back from overseas and then incur taxes. Further with the morning reading, let's take a look at this money flow chart from Shadow Trader. Notice that the red arrow illustrates the direction of money flow since we last reported the status about a week ago. The bearish direction includes yesterday's diversion from the closing price of the S&P 500. It'll be interesting to see if continued bearishness of money flow is a prelude to the market's reaction to today's Fed announcement. And indeed, what he's referring to here, obviously price action's going up, but money flow has been dropping. So always something of thin ice when you see that kind of divergence. We'll see if it has any implication to what the market actually does once the announcement comes out, or if the announcement just simply by itself overwhelms everything. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:38 a.m. Central Time, and I'm recording this in preparation for the market day of June the 17th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into our regular morning reports. In terms of overnight action, fairly calm, slightly bullish at the time of this cut. Obviously, we normally see maybe the first hour with some action after the cash open, but then things usually go fairly quiet. Usually the overnight ahead of an FOMC or a monthly employment report is usually pretty flat, and this seems to be the case last night. All four broad market indices are up, we'll call it scratch to just maybe less than 0.25%, with the Dow being right at the 0.25% mark. Crude oil up big, up about 2%. Euro essentially scratch. Bonds down just slightly, we'll call that scratch as well. And then gold the same, basically just a little teeny bit of weakness. Overseas, the big one was China. Remember, China had a big down day yesterday, and today, as in the overnight, it was up 1.66%. Hong Kong up 0.7%. Japan, just a teeny bit of weakness. Germany down 0.4%. United Kingdom down just a little bit more at about 0.5%. In terms of macroeconomic reports, of course, the big one is the FOMC. And you have, in addition to that, you have crude oil inventory. So, clearly is a big macroeconomic event for today. Remember, once that report comes out, don't be too quick to judge the reaction. You often get the initial thrust, then the reverse, often refilling right back to where it came from, and then settling into a move. Usually on even the third move is probably the primary move, but many times the first initial reaction to the report is not the true reaction. So be very careful, wait for things to settle down and for the news to be digested, and to see just what the reaction to that is going to be. In terms of tomorrow, we have our regular Thursday reports, the weekly unemployment. You have Philly Fed manufacturing. You have natural gas if you're a trader in that market. And that should pretty much cover it. CPI along with the unemployment report in the pre-market hours. And let's see here. Let's go to volatility. Well, in general, volatility has been decreasing. You see the 5-day versus 10-day ATR. Short-term VIX 16.29, so this is quite a bit higher than it has been in recent days, but still nothing extreme. Skew also not extreme, only 120. IV percentiles 28, 16, 28, 43, all in the lower half, perhaps a bit higher than they have been many days of recent, but still nothing here to get excited about. No standard deviation moves were put in yesterday. We still remain, a little below average in terms of the number of standard deviation moves in the last couple of weeks. So really, all in all, while a bit higher than perhaps we have been seeing, volatility levels in the current market have been relatively low. In terms of our regular daily report, typical of recent phase 3, higher highs, higher lows until proven otherwise. IBD status remains in a confirmed uptrend, the longest period of this year. Accumulation distribution has a little bit of a warning though. It's a D- in the S&P, and the Nasdaq is a C. GMI index is a 4 out of 6, so not as healthy as it could be. The intermediate term market posture is bullish, though relatively weak ratings, and obviously today's FOMC report will probably have an awful lot to say whether this gets confirmed or we just continue to see these warning signs come in. But S&P 44.7, Dow even weaker at 34.1, Nasdaq more bullish at 75.5 and the verge of going to very bullish. Russell is very bullish at a 92.6. Overall hedge warning status 0 plus, normal with cautionary aspects. And from a volatility base, we have a couple warnings in place. Market in decline and the sharp increase warning have both flagged. We are still in that situation with the VIX daily squeeze having fired to the long side, so that is a warning that the market could be falling down. Distribution day count has gone to warning status at 5 and 5 for both the S&P and Nasdaq. And then on the intermarket risk aversion indicators, we still have 2 as risk off, but also note that 2 others are rolling over and are in danger of flagging risk off conditions. So there's quite a number of what we call these cautionary aspects. This is clearly not a strongly bull and strongly healthy bull market. In our special opinions, option income strategies, VIX is inside the acceptable window. Just keep in mind the potential for the increased volatility. Cover call strategies, cautiously bullish. If you go with that cautiously bullish approach and use a 3-to-2 distribution between in the money and out of the money strikes, should be okay to move forward with cover call strategies and highly selected stocks. Put selling conditions are acceptable for new core put portfolio positions, but given the relative range-bound activity, consider put credit spreads with defined risk and consider scaling into positions until the market has confirmed a breakout from the trading range and shows greater health. In terms of sector specific, the market postures you see here, pretty much Christmas tree. Not a lot of great things to talk about though. Consumer, discretionary, healthcare, financials, and retail are perhaps some of the names that we've been talking about on a more consistent basis, that if things are going to look good, going to look up, those are probably the sectors in which you're going to see the up. Transportation and utilities and energy on the other side have consistently been the sectors that have performed poorly, and that certainly is represented in today's market postures across all 3 time frames. In terms of specific change, you see yesterday was a fairly good day. All sectors were up and are all holding up in the 5-day, but as you see in the 1 month and 3 month, it's a bit more mixed. We've had a difficult time, putting together any kind of strength And even for the best here, you have financials at 1.35% return in the 1 month standing. So not been easy sledding of late for the bulls, especially those who hold positions. I think that should be enough for today. As always, if you find what you're hearing here is helpful to your trading, we appreciate you liking us on YouTube, or if you found us through Twitter, retweeting us to your own followers. Obviously, we welcome feedback, so if you have something that you'd like to offer, a suggestion or other feedback, support at falconglobaltraders.com is the email address. More information is available at this website about what we do, how we apply all these concepts to our trading. Transparency is a core principle for us, and we certainly are very transparent, and this is using a modeled position size. Disclaimers as always. Hit the pause button to review this at your convenience. And then of course we always appreciate you each and every trading day here at the Falcon Global Trading Community. Good trading and goodbye.